you're an American moving to Canada or a Canadian moving back home, one of the most misunderstood and potentially overlooked areas of tax planning is what happens to your non-qualified or non-registered or taxable investment accounts. Think your stocks, your mutual funds, your ETFs that are held outside of retirement accounts like IRAs and 401ks. In this video, I'm going to walk through what happens to your US investments for Canadian and US tax purposes after you move to Canada, what kind of regulatory and tax reporting matters you need to look out for, and importantly, what kind of tax planning opportunities you have ahead of your move to make sure that you stay on side. This is one of those areas where misunderstanding the rules and getting things wrong can cost you a lot in unnecessary taxes and potentially have you face regulatory hurdles that can lead to unexpected surprises. I'm Sonia, I'm a CPA licensed in both Canada and the US. I'm a cross-border tax consultant, and I'm the co-author of my new book, Your Move to Canada, all about the financial, tax, investment, and estate planning matters as it relates to moving from the US to Canada. Keep in mind, I cover everything that I'm going to be discussing in this video in this book, and I have a lot more detail and examples within. So let's start. Can you just keep your investments in your existing US brokerage? So I'll talk about two issues with this approach. Firstly, it may be possible, and there's nothing necessarily that's against the tax rules with this. The first thing you want to keep in mind is regulatory issues. Both the Canadian and US financial systems are heavily regulated, and I won't get into all of the details, but your US brokerage may not be able to continue to manage your US investments after you move to Canada because they may not be licensed to deal with Canadian tax residents. What that means is they might not tell you you have to liquidate the account or move it elsewhere. They might essentially freeze it and set the account to sell only. What this means is once this account is in the sell only or frozen status, you can no longer purchase new investments, you can no longer rebalance your portfolio and make any changes in light of changes to the market. The second issue is tax reporting. The US financial institution is not going to be preparing tax slips for Canadian tax purposes. So, technically you can manually report the income for Canadian tax purposes into Canadian dollars and abiding by Canadian tax rules. However, this could be a bit of a burdensome and manual process, and if you're going to be paying an accountant to do this, then that could end up costing you more as it relates to paying a tax professional to go through this process. Once you become a Canadian tax resident, you're subject to tax on worldwide income. Any dividends, interest, and capital gains in this US brokerage account have to be reported for Canadian tax purposes. Now, if you're going to be a US citizen or green card holder and living in Canada, you also have to report that same income to the US. So ideally, you may be able to work with a brokerage that could produce both the Canadian tax slips for Canadian reporting purposes and also the US tax slips, the 1099 forms, for US reporting purposes for the same account. So there are Canadian brokerages that can do this. If you want more information, feel free to send me an email to the contact below. So this reporting consideration alone is a strong factor why you may want to move your assets to a Canadian brokerage. Now let's start with a very practical question. If you have assets in your US brokerage, can you just move those to a Canadian brokerage? For many assets, yes. Your individual stocks and your ETFs, those can be moved in kind. And what an in-kind transfer means, you're moving it directly from one brokerage to the other brokerage. You're not actually selling anything, so there's no capital gains. However, if you own US mutual funds, those generally cannot be held by a Canadian brokerage. So if you want to move your assets from the US brokerage to the Canadian, and if you sell them, if they're in a gain position, that may trigger US capital gains taxes. However, here is a really big planning opportunity. Certain US brokerages that have mutual funds have something called a tax-free mutual fund to ETF conversion. I know Vanguard has a number of these. Why this is a very powerful planning opportunity is, say you want to move your US assets from your US brokerage to Canada, but you have a lot of gains in US mutual funds, and if you need to move those, it would result in needing to liquidate those and trigger huge capital gains. But the US tax code does allow for certain mutual funds to be converted to ETFs tax-free. And once you have those in ETFs, those can be moved to a Canadian brokerage. So you're essentially just avoiding a huge taxable event. Keep in mind, not all mutual funds offer this option, but it's worth inquiring with your US brokerage if it's something that you could do. Next, let's talk about capital gains in Canada. One of the biggest misconceptions that I hear is Canada taxes you 50% on your capital gains. Well, that's not true. It's a misunderstanding of this 50% rule. In Canada, only 50% of capital gains are taxable. So let's say you're in a 30% tax bracket. That means that 50% of the capital gains, you pay 30% tax on that. So they're actually taxed preferentially compared to other incomes such as employment income and interest. So, very important distinction to keep in mind. It's not a 50% tax, 50% is taxable. Now, let's talk about one of Canada's more generous tax rules when it comes to your investments, and that is called the step-up in cost basis. What this means for new Canadian tax residents is your cost basis for future capital gains and foreign asset reporting purposes of the investments that you held at the time you became a resident is the fair market value at the time you established tax residency. So, for example, let's say that you bought a stock while you were living in the US for $50. And then when you move to Canada, it's worth $100. And then you sell it after you move to Canada for $110. Your capital gain in Canada is only going to be the difference between the $110 and the $100, not the $110 and the $50. So any gains that accrued before you move to Canada will not be taxable for Canadian purposes. So a lot of people think, I want to avoid a huge Canadian tax bill, I'm going to rush and sell all of my investments before I move to Canada. But because of the step up in cost basis rule, triggering gains unnecessarily just to avoid Canadian taxes doesn't make any sense. What you're doing is you're accelerating a US tax bill that otherwise could have been deferred until you actually want to or need to sell those investments, given that Canada will not tax any of the gains that accrued before you became a Canadian tax resident. Keep in mind, certain brokerages in Canada that specialize in working with cross-border clients have the ability to track your cost basis for both Canadian and US tax purposes, because if you're going to be a US citizen or green card holder in Canada, your cost basis of those investments will remain the same. In my earlier example, I said someone bought this stock for $50, it was worth $100 when they moved to Canada. For US purposes, their cost basis remains the $50, but for Canadian, it's $100. Remember how I talked about certain brokerages are able to produce tax slips for both Canadian and US purposes. This is going to be tricky, and that's why it's important to potentially work with a brokerage that could actually manage these dual tax slips for you, because the capital gains are going to be completely different potentially for Canadian purposes and for US purposes. Again, this is something that you could manually manage on your own, but it's a little bit of work, or potentially a lot of work. So the choice is yours, but just know that there are options out there. Once you become a Canadian tax resident, you'll want to know what is the fair market value of all of your assets, as that forms your cost basis. I'll link my video below on what it means to become a Canadian tax resident. I note in that video that that is really the starting point of all of your tax planning. A lot of people have the misconception that you are not a tax resident until you become a permanent resident or until you exceed 183 days. There's a few misconceptions. Generally speaking, you'll become a tax resident on the day you move here if you're making a one-way move to Canada. Now, what if you have some investments that are in a loss position? That is, say you bought the stock at $10, but it's currently trading at $5. Well, while the step up in cost basis for Canadian purposes works really well when you have assets in a gain position, if you have assets in a loss position, it could actually work to your disadvantage, and here's why. So going back to the example, you have a stock that you bought for $10, it's currently trading at $5. Let's say you move to Canada. Your cost basis is going to be the value of that asset at the time you establish residency, so $5. But then let's say the stock recovered a bit and it's worth $6 when you sell it. In Canada, you have a $1 capital gain. But for economic purposes, you actually have a $4 loss because you bought it for $10 and you sold it for $6. So it might make sense for you to sell your stocks that are in a loss position before you move to Canada. Make sure you always get financial and tax guidance from a qualified advisor who can help guide you on this process. This is one of those opportunities where it might make sense to trigger capital losses. Capital losses in the US can offset capital gains, and up to $3,000 of net losses can offset your other sources of income. But if you have losses in excess of that amount, those can be carried forward and used against future capital gains or future income. Next, let's talk about state tax. So this is an opportunity for some really good planning. If you live in a state that has a relatively high state tax rate and you want to sell some investments, or potentially you need to liquidate some mutual funds, you might want to hold off on triggering those sales until you actually fully sever that state residency. Generally speaking, states only have a right to tax you on the sale of investments if you are a resident of that state. But let's say you severed state residency and then moved to Canada and then sold those investments, you may be able to avoid state tax on capital gains. Make sure you talk to a tax advisor about severing state residency. There are certain states that have sticky residency rules, and what that means is you may be considered a state resident even if you don't live there anymore, if you still have some domicile in that state. So it can get a little bit complicated, but overall, this is a really powerful tax opportunity. Say you sold the stock right after you moved to Canada, you might not have any Canadian capital gain given the step up in basis, and you might be able to avoid state tax. Now, what happens if you move to Canada if you're not a US citizen or a green card holder? Say you were living in the US on a visa and you have some stocks that have gone up in value. This is one of the most powerful tax planning opportunities you'll ever come across. Once you are no longer a US person, not a US resident, not a US citizen, or a green card holder, the US no longer has a right to tax you on the sale of those stocks. And there's no exit tax if you move out of the US on a visa. And then when you come to Canada, you get a step up in cost basis on those stocks. So what does this all mean? It means if you don't sell those stocks as a US person and you sell them after you move to Canada, any gain that accrued during your US residency on those non-qualified investments will be completely tax-free, both in Canada and the US. This unfortunately is an opportunity only available to those who are not US citizens or green card holders. Very, very powerful opportunity to those who were in the US on a visa. And to close off, again, if you're moving assets from a US brokerage to a Canadian brokerage in kind, you're not selling anything, there are no capital gains that are triggered. And thus, it's not a taxable event. So the key takeaway here is if you move to Canada, doesn't mean you automatically need to sell all of your investments just to avoid our high Canadian tax rates. You get the step up in cost basis, and capital gains are actually taxed advantageously here. If you're going to be a US person, you'll continue to be subject to US capital gains tax. If you end up paying Canadian taxes on capital gains and you have a US tax liability on the capital gains too, the Canadian tax can be used as a foreign tax credit against the US tax to ensure that there's no double taxation. If this kind of stuff interests you, and if you want to learn more about what you need to know when it comes to moving from the US to Canada, make sure you check out my new book, Your Move to Canada. I'll leave a link below to purchase. Let me know what other kind of cross-border tax videos you want to see. Have a good day. Bye.